Welcome back, everyone. My name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management, and thanks for joining us again this week live, where we review everything that we saw in the markets last week and what we see coming up. Today, we're going to be talking quite a bit about inflation and what that means for your portfolio and how you can manage that in your portfolio. So we'll get to that after we get through the market news. Of course, you can always watch these if you're watching live with us. Catch us every Tuesday at noon. We do have specials out on our mikeonmoney.com channel and our podcast if you want to catch any of those as well. So we try to do a deep dive once a week. But with that, let's dive into things this week with everything in the market. As always, remember, everything we talk about is just for your information purposes, for educational purposes. Always do your own due diligence or reach out to a professional advisor to get advice on your specific situation. Everyone's unique, and make sure that this information is current, because things are constantly changing, but also that any strategies we might talk about are appropriate for your situation and your portfolios. So again, if you're with us live, feel free to hit that Q&A bar if you have any questions. Happy to answer those along the way, or definitely follow up with you afterwards. If you are watching this on a replay of the podcast, just go to mikeonmoney.com. You can reach us there by phone, email, book an appointment, or send in any questions you might have. So with that, let's dive into what's going on in the economy. Texas in the US, the Texas Manufacturing Outlook survey for February is coming up. So we'll get an idea of how much capacity and the factories have been working on and what their outlook is. We're just coming through earnings seasons, so a lot of forecasts coming out on that front to see what the stores or what the companies are forecasting for the balance of this year after a rocky start, I guess you could call it, or bumpy start anyway, to 2021 across the board. We are seeing a bit of weakness in the markets starting Monday and Tuesday. That's pretty much across the board, whether it be S&P or the NASDAQ, the tech stocks being hit a little bit harder at 1.3% yesterday. They were off again today. Pretty much just, things we've been talking about for a while now. The unemployment numbers are still high. There's still some repair to be done to the underlying economies. And of course, in the US, they did break through the 500,000 total deaths due to the coronavirus this week, or I think Monday or late Sunday. So a little bit of reality check for some down there. Although when we talk about the vaccine distribution, we'll see that the US has been able to ramp it up quite a bit faster than their initial launch, and certainly ahead of Canada on that front. We also saw in the US, the Fed's Powell set the table for Biden's economy, but will he stay for dessert? So basically, we're seeing the Fed's Federal Reserve Chair, Jerome Powell, engineering an economic rescue plan for the US, really focusing on trying to bring in labor reforms to help rebuild that economy. Remember, we've talked about this many times. Yes, things in the markets have been quite strong. Companies and corporations have, for the most part, a lot of corporations have either rebounded or got financial help from the U.S. government. But there's a massive economy that exists in the U.S., which is those hourly wage earners. People are being paid by the hour. Where they don't have sick leave, they haven't got a lot in ways of stimulus and protection, and those are where the largest amount of jobs have been lost. So, of course, been following what's going on with the new administration, trying to get more stimulus packages out, but also trying to move things in the labor market, such as increasing the minimum wage there to $15. Of course, we've already done that in most provinces in Canada. And while a lot of pushback when Canada was starting to do it, it seems the economy has absorbed that and moved through fairly undamaged with it. So we'll see how the U.S. does with those new reforms. Mortgage vendor IPO woes. So we're actually seeing a little bit of concern, just like we've seen on markets, being shown a little bit of weakness as some concerns flow in there. Also seeing that with new highs in the U.S. Housing market, whether they've reached a peak. So the mortgage vendors in the U.S., just like we saw in 2008, they do IPO, they do take those things to market. And there's been 5 vendors that have been looking to do an IPO in what has been a fairly hot IPO market down in the United States, one in Canada as well. They've actually had to pull those IPOs or cancel them or pull them back or reduce the size of them over the last 4 months as investors are a bit concerned around that market, in particular around the housing market in the U.S., the valuations that we've seen there. So are we in a bubble for the housing market in the U.S.? Tough to say at this point. We still have incredibly low interest rates, which tends to fuel the markets, but at the same time, a lot of unemployment. So that means a lot less buyers coming to the market. So it's this balancing act between those two. We're seeing continued funding though in some areas of the venture market. We saw in 2014 a tech platform that was going to help small apartment buildings and other urban structures to become more energy efficient. The U.S. government has promised them $2.1 million to match if they can raise that. They're out there still trying to raise funds. It is starting to pick up as more and more people see that matching contribution be a bonus for this IPO, for this technology platform. However, still not getting all the money there. So just showing the market's taking a bit of a pause. The U.S. housing market budget panel approves the $1.9 trillion COVID aid bill. So this is the second round, or I guess you could almost call it the third round of stimulus coming out of the U.S. This was the Biden's budget that they wanted to get through, so they created that subcommittee to push through without having to have 2/3 of the Senate approval, just the 50%, which they control. So that's been approved today. So we'll see those details coming out shortly. Yellen is who's head of the U.S. Treasury, has basically said that she's going to judge, on her opinion of what she thinks of the stimulus package, she's going to judge it based on what happens with the unemployment numbers. And that's what we've talked about for quite some time now. Really what it's going to come down to is unemployment numbers. If those can decrease, that means the economy is growing. How much it's grown by? Well, the U.S. Dallas Federal Reserve, anyway, Robert Kaplan, is looking for a 5% GDP growth in 2021 from the U.S. Possible. I think that's a pretty aggressive one given the unemployment situation there. But if that does turn around a lot quicker than expected, which could happen with the vaccine rollout. An interesting fact I saw the other day, I think it was yesterday, was with Canada's slower rollout versus the U.S. And on top of that, good or bad, with the U.S. not really shutting down much and having such a high infection rate, they could reach herd immunity far sooner than Canada, which might lead to the Americans actually traveling and having things reopen a lot sooner than we will here in Canada, which I think a lot of Canadians, given the effort that we put in compared to them, will be quite bitter about. But I don't think that necessarily would excuse the 500,000 deaths that they've seen down there. U.S. bank software provider Alchemy plans an IPO going for a $3 billion valuation. As we just mentioned, there's a few other ones out there that have started to soften in certain areas of the market. So we'll see how technology, is still faring as far as the continued IPO froth out there, whether that will extend to the technology market versus the other sectors that we've seen start to pull back a little bit in the IPO arena. As I mentioned, the Canadian market or the Canadian COVID situation, over 850,000 cases so far, over 30,000 still active. We do have the variant coming through in Canada here. A lot of concerns about in the public schools as some variants have started to show up in there. I think there's some protests around that today. But the numbers, I guess, or the hospitalization rate and everything are starting to come down here in Canada. Obviously, there's a lot of concern with the March break for the schools coming up, what that's going to mean, and all these new quarantine and testing requirements for any travel, obviously being put into place to stem or prevent some of that travel, especially international travel over that March break that we're heading into here in the next few weeks. So what's going on in the economy? As well as I mentioned, we're still seeing the earnings reports coming through. We're waiting for Home Depot's coming out. It's supposed to be very good. The home renovation trend continues to be very strong as people, of course, are at home. They're starting, whether it's long-term improvements, whether it's just upgrades, or they're just trying to nest a little bit in their home and make some changes and make it more comfortable. There's obviously been a surge in that. If you talk to any of the home renovation contractors or supply chain, they're all pretty much tapped out. They're all going full steam. And in fact, prices for materials, pricing and lead times for materials around home renovations or home repair have gone up substantially over the last year. So we should see good numbers out of Home Depot there. Macy's is looking to report as well. And one thing to keep in mind of these reports, one of the big things we're looking at is what the new forecasts are. Of course, we kind of know what has happened over the last quarter, but what are they expecting as companies? What are they seeing as far as trends go for the months ahead, the next quarter ahead, to see if they see better improvements than they've seen in the past quarter. So Macy's is coming out with theirs. We do expect that to be negative, but we are, eyeing their forecast as to whether they think the sales are going to rebound or whether the vaccine rollout is fast enough for them to start seeing some better numbers in the next quarter for their sales as well. The conference board is scheduled to release the consumer confidence index. Likely reading of comparatively 90 for February versus the previous month of 89. So we are seeing a little bit more confidence that this vaccine is going to lead to some more improvements down the road. Obviously, some concerns right now, but down the road. And what we've seen in other countries where they're further ahead on the vaccine rollout, we are seeing the reduction of spread. So just some numbers I saw out of Israel, who are, I think they're past 50% of the population already vaccinated, and they've seen the infectious rate drop by over 90%. So, very, very positive. Again, the vaccine is not a cure, but if it can slow down the infection rate, we can get things under control. And also we're seeing in the UK, where they're also pretty far ahead on their vaccine rollout. They're talking about reopening things again as those infection rates are starting to fall at very strong numbers. Boeing, if you follow this in the news, of course, Boeing's had a heck of a year, almost 2 years. First with their MAX 8, of course, 737 MAX 8 being grounded due to the devastating crashes that they had with those. They just got reapproved in the last month to go back in the air, but of course, airlines are flying very much these days, so that's not good for Boeing. And now some of their 777, if you saw down in the U.S. over Colorado, the cities in Colorado were bombarded with parts of an engine that blew apart mid-flight. Luckily, no one being hurt, and the plane landed safely. But that's caused a grounding, if you will, of many of the older 777s for inspection while they figure out what was the cause there and whether it's systematic or if it was just that one plane, as they're concerned over people's safety, of course. Google is resuming accepting political ads. So if you follow us through the election, through the Capitol riots, Google and many others like Facebook had shut down election ads to try to stem, let's call it disinformation is how they worded it, I believe. But certainly attack ads that were trying to mislead people around different parts of the US election. So Google has now turned back on accepting ads as of February 24th, allowing the advertisers to start politicizing for any campaigns or advertising for any programs that they have out there. Goodyear's out there still. We're still seeing a lot of mergers and acquisitions. Goodyear went out and bought Cooper Tire for $2.8 billion, really to expand their North American and China presence for light trucks and SUVs. More consolidation in that sector. In fact, and don't quote me on this, I think we're down to now maybe three different tire manufacturers. So all the different brands of tires you see out there, it's basically down to three manufacturers with this acquisition that they're all made by. Maybe sub brands and different labels they have on them, but roughly there's basically three different brands out there. As we see the vaccine coming out, we talked, I think last week or the week before, we talked a little bit about, some harder hit hospitality sectors, whether it be hotels or airlines or cruise lines, that we're starting to see some early movements in the stocks. As I mentioned, I would probably play that through the hotels. I'm not sure if I'm as confident with the cruise lines or necessarily the airlines yet. But Royal Caribbean are seeing a lot of advanced bookings as people are eyeing those vaccines. In fact, I saw another report on the airlines that if you went to try to book some flights for December vacation, you have a real hard time, that they're pretty fully booked right now. Not surprising, because of course they've cut so much of the air traffic, so many of the routes have been really brought down to skeletal numbers as to how many planes are in the air at any one time. So if we do see an improvement, if we do see things reopen with the vaccine, obviously the airlines will start adding more flights, and now those things will reopen again. But with that, we are seeing people jumping on. I don't know if there's a lot of deals with the cruises yet, but people are jumping on bookings. Maybe these are just rebookings of cruises that people had before, where they're just applying those credits for a hopeful future date this year, maybe into next year. And UK have blocked Epic Game from contesting Apple's Fortnite ban. So this goes back a while. We talked about this. This is a lot of the tech giants are in some pretty big antitrust battles, either with governments or with within not infighting, but they're different. Apple and Fortnite. Fortnite is a game manufacturer. Apple, of course, is the hardware manufacturer. They're in battles. This one, basically, Fortnite did this in the United States as well, where they bypassed the Apple Store. So the Apple Store, of course, whenever you buy something on your Apple Store or on your Google phones or Android phones, those companies take a cut from that sale. And I believe, if I remember going back from the original battle in the US, it's about 30% that Epic Game gives up to Apple. So Epic actually redirected the people playing their main game, Fortnite, to the Epic site, said, well, buy it here, and it's cheaper, because they didn't have to pay that 30% to Apple. And Apple, of course, sued them for doing that, because that violated their terms of being on the Apple Store. So they kicked Fortnite off the Apple Store. There's a big battle in the US. I believe they got back on the Apple Store in the US, but in the UK court has upheld Apple's right to kick them off the platform. So that's an ongoing court battle that's going to go on for quite some time. In Canada, we're seeing the Canadian banks are set their earnings to decline a little bit, but investors are still optimistic. So we actually have seen a bit of rally in the bank stocks in the last few days, even though they're dropping some forecasts for the profits. Mostly that's moved on the yield curve. The bond has risen a little bit, which will cut a little bit into the lending profits. But not a huge turning point, as we've not seen official rise in rates, or even a signal in rising rates from the Bank of Canada. Gum to gummies. This is Bo Wrigley, a billionaire. Bo Wrigley Jr. is taking his cannabis producer, Parallel Public. He's going to merge this summer with Canadian listed Ceres acquisitions of out of Atlanta. So they're just taking it's gum, it's edibles, right, for the cannabis industry. So they're doing a merger there and taking that public. Allied won a war with G4S over the auction of Garda World. So this is in the security world, corporate security, private security firm, G4S, where there's this battle between Allied and the battle between G4S and Allied over the acquisition of Garda, and Allied has won in an auction to take that over. So that's been going on for a little bit. Just Energy, which is, rooted here in BC. So Just Energy, if you're not aware, a company that's an electricity and gas provider. Basically, they buy in the open market and resell. They've been struggling for several years as we've seen the movement in the commodity prices go against them a little bit. They had some leadership changeover. They did some refinancing. They were basically turning things around. I believe the Patterson Group is actually quite involved in this in an ownership perspective. And they were turning things around until recently. Of course, we saw down in Texas, and those storms resulted in $250 million in loss, which will highly impact the recovery, and whether that's going to be able to turn around now is much in doubt. So we'll keep a close eye on Just Energy. Not something we've had in the portfolios for a long time. I think we did have it in there, I want to say 5 or 6 years ago, but long before the triples began. On the US dollar front, Monday slightly ticked up higher. And again, as always, the theme here, markets go down, flight to safety goes to the US dollar, so it drives it up a little bit. Doesn't really change the overall trend and direction that we see for the US dollar, but we did see it tick up slightly yesterday, just on those fears. As I mentioned, the bond, 10-year bond, ticked up just a tiny bit, which does affect profitability for banks as they use that to finance longer term, especially commercial debt. On the commodity front, oil rose again slightly, ticking up a little bit. We're definitely seeing the oil manufacturers starting to make some money with $60 a barrel. This trend, we do foresee it continuing to be quite strong. I heard recently that here in BC, we might see gas going up to about $1.70 a liter for the summertime. Not great if you're driving around, but good for the oil manufacturers who, if they can keep the price per barrel over $60, will actually lead to a pretty good recovery for them. Demand is still not there. Of course, this is a little bit of betting on future demand increasing, or should say that, not future demand, not getting to new highs, but just recovering a bit from the lows. Let's qualify it as that. And also on the fact that, remember, if you followed us through 2020, one of the reasons why oil has been able to recover this much is OPEC and OPEC plus countries have all agreed to turn down production or reduce production dramatically to reduce the supply. So we've reduced supply. Demand has slowly moved, but not really much off the bottom, but a little bit off the bottom. And the optimism that we're going to see a rise in demand later this year, or further rise off the bottom in demand later this year, as long as that supply stays low. Those countries have to continue to agree not to increase supply to the world, because really easy for Saudi Arabia or to Russia to dump a bunch of cheap oil onto the market, which would throw all that off. So hopefully not. Certainly that's not the plan that they've gone in with, and hopefully they stick to their plan for those producers who are now at least able to get production going. This doesn't mean I wouldn't go out and rush out to the rigs, or any of the companies that are big on new projects, right? The smaller producers that need to open new projects, because again, that supply is still being tried to squeeze down. So as long as there's not a lot of new projects coming on board, the price will stay high, and current producers can start to make some money and start to recover their balance sheets. in hopes to eventually bring some more supply on the market down the road. But for now, really, it's just a maintenance and kind of get things shored up a little bit. Gold edged up a little bit higher. Gold, we've talked about it through the last year. It's a great hedge for inflation. We still really like it. We still have it in the portfolio. It's not really performed much in the last 3 or 4 months, as we have seen this battle back and forth, especially in the US with the stimulus package that just got approved today. Because of course that's printed more money, causing more inflation. But the gold market was kind of teetering on which way the US was going to go with their stimulus package, and also how quickly the economies can go on their own, and whether we need more stimulus down the road. So a little bit of slow go as far as the gold pricing goes to the start of this year, but still the outlook is inflation, and gold's a great hedge, and we're going to talk more about that inflation thing. Copper did see a big run up, hitting over 9,000 a metric ton for the first time in almost 10 years. So if you were in the materials or copper space, obviously it's been great. We've seen a big increase in demand, and we see more of that in the coming years. And that's pretty broad based, but of course we have talked about the electrical car market, electrical vehicle market, and copper is a big component or big commodity into those components. So we do expect that to continue to move over the next little while. So let's talk about inflation and the possibility of the US economy heading towards a time of significant inflation. And we say the US, we focus on it as the main or the largest market. But of course, this is a global issue. Different countries are facing inflation pressures at different rates, dependent on how badly their economies were affected through the COVID shutdown, how much stimulus, so how much money did they print, and how quickly their economies recovered as they come out of it. So how fast are they getting things back up and running? But if you're invested in the North American market, here's kind of ways to insulate or protect your investments. So we talked about gold. Gold's an easy go-to. It's a simple reverse hedge. Gold goes up, but inflation goes up, right? So as currency values go down, gold goes up. So especially US dollars. So gold is a really easy inflation hedge into a portfolio. That doesn't mean have your portfolio 50% gold, because you're taking on a lot of risk. And as I mentioned, even with that risk of inflation looming here for the last 3 or 4 months, gold has stayed pretty flat. So not a big run up in that area yet, but as we see that turn, having an exposure to gold in the portfolio, a great idea. Commodities are also a good inflation hedge. In times of inflation, commodities tend to adjust their price to reflect the higher price, which is why when we talk about consumer price index or inflationary impact on your spending power, it's around commodity items, things like gasoline and heating oil or natural gas, all these things that go into our day-to-day lives. So commodities get repriced automatically or naturally through inflation. So they're also a good inflation protection, and they tend to perform better in an inflationary period. Diversification. So obviously diversifying your portfolio, but really looking at things like utilities or high dividend paying companies. So your power companies, whether it be electrical, pipelines are another good one. Any industry or company that can reprice their services or offerings based on higher pricing. So electricity, for example, if inflation goes up and things cost more, they just pass that cost on to us as consumers, and we just pay more. So great way to diversify the portfolio is to keep those inside the portfolio, having a strong exposure there. Real estate tends to be a good inflationary hedge. Now, we've talked about real estate. We're in a very big conundrum when it comes to real estate right now, not just North America, but globally, because we did a whole video on real estate, or REITs, real estate investment trust, when we talk about that's a very broad sector when we talk about real estate. because you have everything from office building to commercial building, residential, industrial, etc. So, and then you have geographies as well. So we have this divergence in real estate right now happening, especially around the office buildings. Obviously, people working at home, companies really reassessing, do they need that much space? How many employees do they actually need in the office? How many can work remotely? All that is in a massive state of flux. And of course, we have that on the retail front as well, as retail stores had to make a big shift to e-commerce. So they're relooking at how much square footage they need, how many different stores, locations that they need in order to service or maintain the same type of revenue or profitability. And that, goes into your hospitality chains and of course, restaurants as well. All these areas that were heavily impacted are all really reassessing their need for how much square footage they need. So that's affecting the demand on those areas. So when we talk about real estate as an inflationary hedge, really what I recommend is to really keep a focus on is industrial space. There's a massive shortage of industrial space, not just here in Canada, but in the US. We have a lot of open space in both countries. However, industrial space needs to be close to market, right? Like you need to be close to distribution centers. You need to be close to delivery points. You can't be in northern BC outside of Prince George and try to service the lower mainland on a cost-effective basis. So industrial properties are in high demand, which means revenues for those properties are going up, and so are valuations. So that's where I would look at if you're looking at real estate, is really focus on the industrial front. High yield debt. So high yield debt, this is your I don't say high risk debt, but high yield tends to be higher risk than say a triple A rated debt. You could look at triple B rated, which is where we would normally look for what we call high yield debt. Yes, there's higher risk of default in that arena, but they tend, because they're slightly higher risk, they have to pay their lenders more money, and they adjust quickly. They tend to be shorter term loans, and they adjust quickly to higher inflation and higher market pricing on debt. So if you want to keep up with it, you might want to consider some high yield debt. Again, you are going down to a triple B status, triple B minus status. That's not, the ranking of debt, from triple A, double A, triple B, B, double B, all the way down to C and down to C minus. So it doesn't mean they're default. Yes, they're higher risk. I would definitely consider having a portfolio of higher yield debt. So maybe buying an ETF that holds 50 different issuers in there. And even if 2 or 3 of those were to default, you would still do well with it because the other ones would carry it. As opposed to buying individual names, especially if your portfolio is not one that you can buy several different names to offset that risk yourself. So that's one area of the market to keep in mind that does well. And then lastly, tips. So tips are generally government bonds, not always. There's some private ones out there. These are just bonds whose interest rates move with inflation. So inflationary protected treasury, inflation protected service and bonds. So I like some of the government ones. On the US, you can buy one. The symbol on the exchange is actually tips. And so their interest rate adjusts upwards with inflation. Not great to own these in a declining inflation market or deflation market, but of course their interest rates are being cut on you. But as inflation is going up, then your interest rates or your payments are increasing as well. So they're another way to look at kind of your bond side of your portfolio and protect against rising rates or potentially rising inflation in there. So those are 6 easy ways and definitely things to consider. We're definitely doing this in the portfolios. We made some changes in December to look at a lot of these different areas. As I mentioned, we've had gold, commodities, we've introduced oil back in December, which has been doing incredibly well. Utilities, we're always been a big fan there. Industrial real estate, we've been there for a while. High yield debt and tips we have not moved into yet, but they're definitely on the radar for the portfolio. So something to keep an eye on, and also something to look at if you're doing anything on your own. So with that, that's what I have for you this week. Thank you everyone for joining us. Again, if you want to rewatch this or forward it on, you can go to mikeonmoney.com. Love to hear from you guys if you have any tips or suggestions for us to keep, so for any of the future topics that we do. And with that, I will talk to you again next week, and enjoy your week. Hopefully we have a sunny one this week. Thanks. Take care.